In September of this year, the non-government base of the national pension system achieved the milestone of crossing 1 lakh crores of assets under management. In doing so, this base of corporate and retail subscribers has breached the 30 lakh mark and has been adding a little over 50,000 new subscribers every month. While this progress has been gradual, it is certainly heartening to see more and more Indians warming up to the idea of building a retirement corpus using NPS that not only helps them save taxes but also does a remarkable job of beating inflation. In this video, we shall examine the present NPS environment, which includes the different classes of funds, their construct, performance, and most importantly, how should one go about selecting the ideal pension fund manager. Let's begin. The ETMONEY YouTube channel has already played host to a series of highly recommended NPS videos. We have a video in Hindi which gives us a complete overview of the national pension system, another one which explains the taxation benefits in greater details, and a third one which answers some of the most commonly asked questions on NPS. So very quickly, here's what we know about the national pension system. Firstly, it is a voluntarily defined contribution system, which basically means that the value of your pension pot depends on the money you invest, the asset classes you choose, and of course on the fund's investment performance. Specific to asset classes, NPS offers a total of 4 options. Class E, where E stands for equity, and the money invested here goes into stock market instruments. Class G is government securities, and money here goes into bonds and securities that are issued by the central or state government. The third asset class is Class C, where C stands for corporate debt, and money here goes into bonds issued by PSUs, public financial institutions, infrastructure companies, and money market instruments. And finally, we have Class A, which houses alternative investment funds like commercial mortgage-backed securities, real estate investment trusts, infrastructure investment trusts, etc. It's often this combination of these 4 asset class, E, G, C, and A, which has the largest bearing on how much your NPS grows to by the time you reach your retirement age. Now, to help subscribers with their asset allocation, the National Pension System offers 2 choices, the auto choice and the active choice. The first one, the auto choice option, is designed for passive investors who prefer an automatic allocation of their portfolio across asset classes. This automatic allocation is done using a life cycle based approach, which starts with an equity heavy portfolio when the subscriber is young and systematically rebalances and reduces the equity exposure as the subscriber approaches retirement. The objective of this approach is not only to optimize returns, but to also cushion the subscriber's portfolio from any severe market volatility as he or she approaches the maturity date. But having said this, the auto choice investor does have to make one decision, and that is the type of life cycle fund. You see, under NPS, one can choose an aggressive life cycle fund where the maximum equity allocation can go up to 75%, or the subscriber can opt for a moderate or conservative life cycle fund where equities are capped at 50% and 25% respectively. Now notice I use the word up to 75% when referring to an aggressive life cycle fund, and that's because the equity allocation here is done on the basis of an age-based auto choice table that the PFRDA follows. For instance, if you are 35 years old or younger, then your auto choice NPS portfolio will have 75% in equities, 10% in corporate debt, and 15% in government securities. But as you grow older, the aggressive life cycle fund will continually and automatically optimize your portfolio by reducing equity and increasing the proportion of government securities. So if you were to join the NPS program at, say, the age of 42, then per the auto choice rules, your equity proportion of the portfolio will be at 47% and will continue to reduce as you grow older. This pattern of reducing asset class E and increasing asset class G is the entire basis of the auto choice option, whether the subscriber chooses the aggressive, moderate, or the conservative life cycle approach. An active choice option is available for NPS subscribers who wish to decide their own asset class allocation, that is, the ratio in which their portfolio will operate across the 4 asset classes. So there's a lot of freedom here, but there are also some conditions that need to be satisfied. For instance, the maximum permissible allocation to equities is 75% and not 100% as per the NPS rules. Similarly, the alternative investment funds are capped at 5% and is available only to Tier 1 NPS subscribers. And thirdly, equity investments in active choice accounts also have an age-based condition that needs to be complied with. So per the NPS rules, the active choice NPS subscriber is allowed to maintain a 75% equity exposure until the age of 50. But once the subscriber crosses 50, the equity portion starts to taper off by 2.5% every year until it reaches 50%, which happens by the age of 60. While this might come as a dampener for the more aggressive investor, this set schedule is in line with the PFRDA's objective of reducing portfolio volatility as the subscriber approaches his or her retirement age. So net-net, while the auto choice option offers a passive rule-based approach to asset allocation, the active choice option offers a lot more flexibility and freedom to the subscriber. Now, to manage NPS assets, presently there are a total of 7 pension fund managers. In alphabetical order, these are Aditya Birla Sun Life Pension Management Limited, HDFC Pension Management, ICICI Prudential, Kotak Mahindra Pension, LIC Pension Fund, SBI Pension Funds, and UTI Retirement Solutions Limited. But having said this, the PFRDA has now increased the number of fund managers to 10, with Axis Asset Management, Tata Asset Management, and Max Life Insurance receiving the necessary approvals to establish a pension fund company. When it comes to investing in government securities, the average NPS fund has delivered an annualized return of 10.2% over the last 8 years. Now, 10.2% in isolation doesn't mean anything, which is why we compared it with the Nifty 10-year benchmark GSEC index, which is often used as a benchmark by gilt mutual funds. What we saw here was a bit surprising because while the NPS funds had delivered over 10%, the Nifty 10-year GSEC index had an yearly return of only 7.5% over the previous 8 years. In fact, our data showed that the Asset G NPS funds had outperformed their counterparts in the mutual fund industry during the same time period, which begs us to ask the question, why are NPS funds doing so well? Well, one visible factor is definitely the expense ratio, and there is a big difference between what NPS funds and what mutual funds charge. But what seems to be the prime reason for this differential is the average maturity of these schemes. You see, a gilt fund generally has an average maturity of 8 to 11 years. However, NPS schemes seem to have a much higher maturity of 14 to 17 years. Of course, this is not necessarily a good thing as it makes the NPS schemes more volatile, and this can easily blow back in a rising interest rate scenario. But with the interest rates moving in a downward direction, this has yet to happen. However, the past is the past, and with interest rates expected to increase from here, there is that possibility of NPS schemes underperforming if they were to hold on to longer maturities. But let's get back to the data and examine the performance of different pension fund managers on an yearly basis. Alright, so this table shows that all 7 fund managers have outperformed the Nifty 10-year benchmark GSEC index in each of the last 8 years except the year 2015. When we visualize the same data from a ranking perspective, the returns delivered by the LIC pension fund does pop out, with them outscoring the others in as many as 4 in the last 8 years. So as it stands, LIC pension funds Asset G schemes have been the top performers in the last few years, and maybe SBI comes a distant second. The performance of corporate debt funds across different pension fund managers have been remarkably similar in these last 8 years. From a benchmarking perspective, the average NPS fund has delivered a little higher returns when compared to the S&P BSE Corporate Bond Index. Now, one explanation that comes up for this overperformance is the composition of instruments in the NPS Scheme C funds. So until 2017, the NPS funds were allowed to invest in corporate debt instruments like rupee bonds, listed debt issued by banks, corporates, tier 1 bonds, etc., as long as the rating was AA and above. However, in 2018, the NPS guidelines were amended to also include instruments with an A rating as long as this exposure was not more than 10% of the corporate bond portfolio. The small yet significant exposure in these slightly lower rated papers might be one reason that has led to a higher returns from the NPS funds. A second area of observation is the average maturity of the debt instruments held. And what we are observing here is that a number of NPS schemes have an average maturity of 6 to 7 years, while the corresponding corporate debt mutual funds have a lower maturity of 3 to 4 years. This too plays a part, as debt instruments with a higher maturity tend to deliver higher returns, although it comes with a lot more volatility. Anyways, the idea here was to examine the performance of our 7 fund managers, and the table here shows that most NPS funds have outperformed the S&P BSE Corporate Bond Index in most years, although there have been some exceptions. When we convert this table into a rank-based comparison, the Scheme C funds of HDFC and ICICI Prudential seem to show reasonable performance and consistency over the years. When it comes to equities, all pension fund managers seem to move as a unified group. I mean, look at the annualized returns of the last 8 years, and one can't ignore the fact that most funds seem to be in and around the average of 14.5%, with only HDFC and LIC a bit further off. From a benchmarking standpoint, since different funds might be following a different index, we have used the Nifty 50 TRI and the Nifty 200 TRI index as our reference points. And as it stands, every NPS fund has underperformed the Nifty 200, with only the HDFC pension fund at least matching the Nifty 50 TRI performance over an 8-year period. From a holdings perspective, most funds within the NPS equity schemes have a very heavy large cap bias. In fact, as it stands, every NPS fund has at least 90% of its holdings in large cap stocks, which sort of answers why the performance of these funds have been more or less similar. Now, most NPS equity funds have generally underperformed the broader index in most years, although we have seen some exceptions from time to time. And it's this pattern of under and over performance that we can use to help us decide which NPS funds have done better than the others. Take HDFC Pension for instance. It has been ranked first or second in 6 of the last 8 years, which makes it the most consistent amongst all NPS equity funds. On the other hand, SBI and Kotak Mahindra funds have seen a few years of relatively high performance and also some years of low performance. While the NPS rules allow subscribers to have different pension fund managers for their Tier 1 and Tier 2 accounts, the rules do not allow a subscriber to choose different fund managers for different schemes within the same tier. In other words, one cannot have SBI pension fund for government securities, then a Kotak for equities, and finally an HDFC for corporate debt. So if a subscriber chooses the SBI pension fund, then his equity fund, corporate debt fund, government securities, and the alternative investing fund will all be from SBI only. Now, considering this, the selection of a fund manager is not really a specific asset class exercise, but requires us to look at how the pension fund manager has been performing on a portfolio basis. And for this purpose, our researchers have built us 4 simple personas of an aggressive investor, a moderate investor, a conservative investor, and a super safe investor. As you might have guessed by now, the aggressive one is heavy on equities with a 75% allocation. The moderate one has a 50-50 splitting between equities and fixed income products. The conservative investor has 75% of the portfolio in corporate debt and government bonds, while the super safe person keeps 95% of the assets in these safer instruments. We then applied the specific percentages over 8 years of data, that is from 2014 to 2021. We also ensured that we rebalance the portfolio every year, which is exactly how the pension funds would also do it. And the table here shows us the results of this study. Now, since the HDFC equity schemes did a little better than the other funds, it leads the race in our aggressive, moderate, and conservative allocation. Likewise, since LIC had delivered the best returns with government securities, it holds the top spot in the super safe category. But broadly speaking, we really could not see an outright winner with all pension fund managers carefully operating around the average. I mean, yes, the HDFC pension fund has outperformed the average by 0.7% in an aggressive environment, but that's still just 0.7% and doesn't really give investors a significant margin of selection safety. But having said this, we expect things to change going forward, and that's on account of some improvements that the PFRDA has done on the fund management front, which we shall look at in the next section of this video. The last few years have seen a number of visible improvements and innovations in India's NPS program. While we have covered a few of them in our past videos, here are some additional upgrades. Well, firstly, the PFRDA has revised the investment norms, which means fund managers can now invest in any stock that is a part of the F&O basket and has a market cap of at least 5,000 crores. This is important because earlier the investment universe for our pension fund managers was very small with just over 100 stocks. But with these revised norms, the number of investable securities has been opened up to a little over 200 stocks, which means there are now over 100 mid-caps that can be chosen from. This dimensionally changes the construct of the NPS equity fund from a large cap heavy fund to more of a large and mid-cap sort of fund, which means the fund managers can create a lot more alpha for their investors over the long run. Another interesting allowance that pension fund managers have been given is for them to invest in initial public offerings or IPOs that meet a certain threshold. So while the fund manager may or may not exercise this facility, this leeway does open up another avenue for the funds to pick up some high growth investment ideas. Yet another news that's floating around is that Tier 2 NPS subscribers might be allowed to allocate 100% of their funds to equities from the present 75%. So that's something interesting. The point is there are a lot more innovations and improvements that are coming up in the NPS space as the PFRDA and the government aims to make the national pension system India's primary retirement savings vehicle. And so far, the performance of NPS funds have been supporting this goal by delivering returns which are far ahead of the inflation rate and what we generally receive from small saving schemes like the PPF and the National Savings Certificate. NPS is certainly one space to watch out for, and if you haven't opened your account yet, then do check out the NPS section on the ETMONEY app for a quick paperless joining process. And with this, we come to the end of this video. I sure hope you found the information shared in this video useful. Please do subscribe to our channel, tap on that like button, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.